Profitable, growing, loved by customers. Stock down 60%. No scandal, no fraud, no bad management. Just 3 letters. AI. Not because AI broke the business, but because AI made investors ask one question they'd never asked before. Is this software still necessary? That question is now a wildfire, and the companies that can't answer it, they're already ash. Welcome to the SaaSpocalypse. And here's the terrifying part nobody's talking about. It's getting worse. What the heck is the SaaSpocalypse? Let's rewind for a second. For about a decade, SaaS, software as a service, was the golden child of the tech world. The business model was genius, almost embarrassingly simple. Charge people a monthly fee forever. They can't leave because all their data is trapped inside your platform. It's like a gym membership, except the gym actually works and you feel guilty canceling. Companies like Salesforce, Adobe, Atlassian, Workday, and Snowflake were printing money. Investors were throwing cash at them like it was confetti at a New Year's party. Valuations were, let's call them, optimistic. Some were trading at 30, 40, even 50 times revenue. Not earnings, revenue. Then 2022 happened. Interest rates went up. The free money party ended. And SaaS stocks started falling. But here's where it gets interesting and genuinely alarming, because the stocks didn't just fall, they kept falling and falling. And then AI showed up, looked at the whole SaaS industry and said, "Hold my beer." Now, AI is threatening SaaS in 2 very distinct and very brutal ways. Threat number 1, AI replaces the tools themselves. Think about what Salesforce actually does. It helps your sales team track leads, manage pipelines, send follow-up emails. Now imagine an AI agent that does all of that automatically for a fraction of the cost. No interface to learn, no seats to buy, no annual contract to argue about. This isn't science fiction anymore. Companies are already replacing entire software stacks with a single AI platform. 1 tool, 1 subscription, 1/10 of the price. The CFO does this and does what CFOs do best. Opens a spreadsheet, does the math, and starts canceling subscriptions. Threat number 2. AI reduces the number of humans who need the software. Here's the sneaky one, the one that keeps SaaS CEOs awake at 3 a.m. Most SaaS companies charge per seat, per user, per head. The more employees your company has, the more licenses they sell. It's a beautiful model, as long as companies keep hiring humans. But what happens when AI lets a team of 10 do the work of 100? Suddenly, instead of 100 Salesforce licenses, you need 10. Revenue drops 90%, not because the product got worse, but because the customer got more efficient. This is the nightmare scenario, and it's not hypothetical anymore. Atlassian, the company behind Jira and Confluence, literally charges per employee. Their entire business model is a bet that companies will keep hiring humans. That bet is looking shakier by the day. The numbers don't lie, but they do confuse. Now, here's the paradox that makes this story genuinely fascinating. Most of these companies are still growing. Salesforce, revenue up double digits. Adobe, free cash flow hitting record highs. Snowflake, still expanding at a pace most companies would kill for. And yet their stock prices look like they fell off a cliff, bounced, and then fell again. Salesforce, down over 50% from its peak. Adobe, down nearly 65%. Atlassian, at one point, down 85%. 85%. So what's happening? The market isn't pricing what these companies are. It's pricing what these companies might become, or more accurately, what they might stop being. Investors are essentially saying, I don't care that you're profitable today. I care that you might be irrelevant tomorrow. And that's a very hard argument to fight. Because nobody, not the CEOs, not the analysts, not the AI researchers, knows exactly how this plays out.
Here's where it gets really interesting. Some SaaS companies are fighting back hard. Salesforce launched Agentforce, their AI agent platform. The pitch? Instead of replacing Salesforce, AI makes Salesforce more powerful. Your AI agents live inside Salesforce. They use Salesforce data. They run on Salesforce infrastructure. It's a clever move, like a taxi company buying Uber, except it might actually work. Adobe is doing something similar. They've baked AI, their Firefly model, directly into Photoshop, Illustrator, Premiere. The argument? Professional creatives don't want to leave Adobe. They want Adobe to be smarter. And for now, that argument is holding. Adobe's revenue is still growing, churn is still low, the moat, that beautiful, deep, subscription-based moat, is still there. But then there's Atlassian. Atlassian's problem is structural. Jira is the tool developers use to track work. But if AI is writing the code, managing the sprints, and filing the tickets automatically, do you still need 500 Jira seats, or do you need 50? Their revenue is still growing, but the growth is slowing. And in a market that prices future expectations, slow in growth is basically a four-letter word. And Snowflake. Snowflake is fascinating because it's actually positioned to benefit from AI. More AI means more data. More data means more need for data warehousing. Snowflake should be winning, but the market is worried about something else. Amazon, Microsoft, and Google, the cloud giants, are building their own data platforms. Why pay Snowflake when AWS does the same thing and you're already paying AWS for everything else? What smart money is actually doing. So what do you actually do with all of this? Here's the thing about market panics. They're almost always partially right and massively overdone. Yes, AI will disrupt SaaS. That's real. Yes, some SaaS companies will not survive the next decade. That's also real. But the idea that Salesforce, a company with 150,000 enterprise customers, $35 billion in annual revenue, and 20 years of deeply embedded data is going to zero? That's not analysis. That's hysteria. The smart money, the value investors, the long-term thinkers, they're looking at this differently. They're asking, which of these companies has a real AI strategy? Which ones are adapting, not just rebranding? Which ones have switching costs so high that customers literally cannot leave? Because here's the dirty secret of enterprise software. Companies don't switch their CRM or their creative suite because a new AI tool looks cool. They switch when the pain of staying is greater than the pain of leaving. And right now, for most of these companies, that pain threshold hasn't been crossed. So here's the real question. Is the SaaSpocalypse a temporary panic, a market overreaction to a real but manageable threat, or is it the beginning of a genuine structural collapse of an entire industry? Honest answer? Both, depending on which company you're talking about. The SaaS companies that will survive and thrive are the ones that do three things. 1. Embed AI so deeply into their product that AI becomes a reason to stay, not a reason to leave. 2. Shift their pricing model away from per seat and toward value-based or outcome-based pricing. Charge for results, not for licenses. 3. Own the data layer. The company that holds the most valuable, most structured, most irreplaceable data wins, always. The companies that fail to do these three things, well, they'll become the blockbusters and Kodaks of the 2030s, profitable right until the moment they weren't. The SaaSpocalypse is real. It's not hype, it's not clickbait. It's a genuine, structural shift in how software gets built, sold, and used. But it's not the end of software. It's the end of lazy software, the end of charging $50 a month per seat for a tool that does one thing and does it badly. The companies that adapt will come out stronger. The ones that don't? Well, the asteroid doesn't care about your revenue growth.